A is for asset. An asset is something valuable that a person, a business, or even a country owns. They expect it to help them or give them something good in the future, like money or other benefits. Your house, jewelry, and artwork are all examples of assets. B is for bank. A bank is a place that helps people keep their money safe and grow it. You can put your money in a bank to save it, or even borrow some if you need it. Banks let people open checking and savings accounts to store their money, and they also help people save for the future with special accounts. There are different types of banks too. There are banks just for regular people, banks for businesses, and banks that help companies grow. Most banks offer lots of helpful services to make managing money easier and safer. C is for cash. Cash is money you can hold in your hand, like coins and paper bills. You can use cash to buy things, pay for services, or settle what you owe. Cash isn't just the money in your wallet. It also includes money saved in a bank or investments like government bonds that can be turned into cash quickly. For businesses, cash means all the money they have on hand or in the bank that they can spend within a year. So cash helps people and companies buy what they need when they need it. D is for debt. Debt is money that someone owes to someone else. When people or companies want to buy something expensive but don't have enough money, they can borrow it as debt. They promise to pay it back later, sometimes in small amounts over time. Debt can be different types. Some debt is secured, which means it's backed by something valuable, like a house. Other debt is unsecured, meaning it's just based on trust. People can borrow money through loans, credit cards, or lines of credit, which they pay back bit by bit. Companies can also borrow by selling bonds to raise money to grow or make big purchases. E is for equity. Equity is the part of a company that belongs to its owners or shareholders. Imagine if a company sold everything it owned and paid back any money it owed. Whatever's left would be the equity. Equity is like a way for companies to raise money to buy things, start projects, or keep the business running. Companies can raise this money by borrowing, called debt, or by selling a part of the company, called equity, as shares or stock. People who buy shares become part owners and hope to earn money as the company grows and does well. So, owning equity means sharing in a company's success. F is for finance. Finance is all about money, how we earn, save, spend, and invest it. It's a system for understanding how money works, like making smart choices with savings and investments. Finance is split into three main areas. 1. Public finance, how governments manage money. 2. Corporate finance, how companies handle their money. 3. Personal finance, how people manage their own money. So, finance is all about making good decisions with money, whether it's for a country, a company, or yourself. G is for growth. In finance, growth means getting bigger or better. It can refer to a company expanding, investments increasing in value, or the economy improving. When a company grows, it makes more products and earns more money, which is great for everyone. H is for hedge. A hedge is a safety net for your investments. It helps protect you from losing money. When one investment goes down, a hedge usually goes up. Think of it like insurance against big losses. For example, if you invest in a variety of stocks that do well in strong economies and others that do better in weak ones, you're using a hedge to keep your money safe. I is for invest. Investing means buying something valuable to make money or help it grow in worth. You can invest in things like bonds, stocks, real estate, or even other unique items. When you invest, you're hoping that over time, what you bought will be worth more, helping you earn some extra cash. J is for jackpot. A jackpot is a big surprise of money that comes unexpectedly. It usually means winning a lot from something like gambling, but it can also happen when you invest. For example, if you buy shares in a company that suddenly becomes very popular, you might hit the jackpot. It's like finding a treasure chest filled with cash. K is for knowledge. Financial knowledge means understanding money and how it works, such as knowing important terms and ideas about saving, spending, and investing. The more you know about finance, the smarter choices you can make with your money to reach your goals. L is for liability. A liability is something a person or company owes, usually money. It's like a bill that needs to be paid. Liabilities are settled over time by giving up money, goods, or services to pay off what you owe. So, if you borrow money or have debts, those are your liabilities. M is for money. Money is anything that people use to buy things and pay for services. It represents value, so everyone accepts it in exchange for goods and services or to pay back loans. Money helps economies work by making transactions easier and supporting financial growth. N is for net. Net income is the money a business really makes after paying for expenses and deductions. It's what's left over after all the bills are paid. So, when you hear net, think about what remains from the total after taking out the costs, like the final prize after all the deductions. O is for options. In finance, an option is a contract that gives you the choice to buy or sell something, like stocks, at a set price by a certain date. This means you don't have to decide right away, but you have the opportunity to do so if you want. P is for profit. Profit is the money a business makes when its income is higher than its expenses, costs, and taxes. It shows how much money is left over after paying for everything needed to keep the business running. Q is for quarter. A quarter is a coin used in the United States and Canada, worth 25 cents or 1/4 of a dollar. You can find quarters in your pocket or piggy bank, and they're useful for buying small items like snacks. 4 quarters make $1. R is for receipt. A receipt is a paper record that shows proof of a purchase or financial transaction. When you buy something, the store or service provider gives you a receipt to confirm your purchase. Receipts can also be used in business deals or banking transactions, helping everyone keep track of what they bought and sold. S is for save. Saving is the money you set aside before or after spending some. People save for all sorts of important goals, like retirement, education, buying a house, or other future events. It's like putting away extra cash for something special you want or need later. T is for trade. Trade is when people or businesses willingly exchange goods or services with each other. Since both sides choose to trade, it only happens if they think it will benefit them. For example, you might trade a toy with a friend if you both agree that it's a good deal for what you want. U is for underwrite. Underwriting is when a person or company takes on financial risk in exchange for a fee. This often happens with loans, insurance, or investments. Underwriters carefully evaluate how risky a situation is to decide if it's a good idea to support it. They help make sure everyone understands the risks involved before moving forward. V is for value. Value is how much something is worth in money or materials, whether it's an asset, a product, or a service. There are many types of value, like shareholder value, market value, and book value. Valuation is the process of figuring out how much a company or asset is worth. By comparing different values of companies, investors can find good opportunities to invest their money. Understanding value helps people make smart choices when it comes to buying or selling. W is for work. Work is the effort and tasks people do to keep society running smoothly. For example, a teacher works by educating students, while a farmer works to grow food. When you have a job, you're using your time and skills in exchange for money or other rewards. This exchange helps support you and contributes to the community, showing how important work is for everyone's survival and success. X is for xenocurrency. Xenocurrency is a type of money that is traded in markets outside its own country. The word xenocurrency comes from the Greek prefix xeno, which means foreign. This means that when you use or trade xenocurrency, you're dealing with money that isn't from your own nation. Y is for yield. Yield is the return on an investment, shown as a percentage. In stocks, dividend yield represents the total annual profit that a company shares with its shareholders. Yield helps investors understand how much money they will earn from investing in stocks or bonds. It's often calculated yearly, but it can also be paid out quarterly or monthly. For example, when you invest in a stock, your gains can come from 2 sources: the stock's price going up and any dividends the company pays out to its investors. Z is for zero-based budget. Zero-based budgeting, ZBB, is a budgeting method where every expense must be justified for each new period. It starts from a zero base, meaning that all costs and needs of an organization are reviewed from scratch. Budgets are then created based on what's necessary for the upcoming period, regardless of whether the amount is higher or lower than before. Unlike traditional budgeting, which uses previous budgets as a guide, zero-based budgeting helps managers find ways to lower costs and spend money more wisely. Now I know my finance ABCs. Next time, won't you sing with me? Please remember, this is not financial advice. If you're interested in exploring the financial ABCs further, check out the link below to purchase your own card deck.